Imagine becoming so rich that selling your own assets becomes a bad financial decision. It sounds backwards. Most people think wealth means having millions sitting in a bank account. But for many billionaires, that's not how it works at all. In fact, some of the richest people on earth deliberately avoid selling their stocks, even when they need billions of dollars to buy homes, fund businesses, or live extravagant lifestyles. Instead, they borrow, not because they have to, because mathematically, it's often the smarter move. And once you understand how this system works, you'll never look at billionaire wealth the same way again. Take Elon Musk, Jeff Bezos, Larry Ellison, or many other ultra-wealthy founders. On paper, they're worth tens or even hundreds of billions of dollars. But most of that wealth isn't cash. It's tied up in shares of the companies they built. Imagine owning a company that's now worth $100 billion. You don't actually have $100 billion in your bank account. You own pieces of paper, or, more accurately, digital shares that the market says are worth that much today. Now, suppose you want to spend $500 million. Most people would assume you simply sell some shares. Simple. Except it's not. Selling creates problems. The biggest one? Taxes. In many countries, when you sell appreciated stock, you owe capital gains tax on the profit. Depending on where you live, that could mean giving away a significant percentage of your gains. But taxes are only the beginning. Large sales can also send a signal to investors. If the CEO suddenly dumps millions of shares, people start asking questions. Does he know something we don't? The market notices. Confidence drops. The stock price can fall. Ironically, selling too much stock can reduce the value of the fortune you're trying to protect. So instead of selling, they call a bank. Here's where things get interesting. Imagine you own $20 billion worth of stock. A private bank looks at that and sees something incredibly valuable. Those shares become collateral. It's similar to taking out a mortgage using a house. You still own the house. You still benefit if it rises in value, but you borrow money against it. Billionaires do the same thing, except the collateral isn't real estate. It's stock. The bank might say, "We'll lend you $500 million. Your shares secure the loan." Now the billionaire has cash. They didn't sell anything. They still own every share. If the stock keeps rising, their wealth continues growing while they're spending borrowed money. It almost sounds like financial magic, but there's math behind the illusion. Let's say someone owns $10 billion in stock. They borrow $200 million at an annual interest rate of 4%. Meanwhile, their stock portfolio grows 12% that year. The loan costs them about $8 million in interest, but their investments increased by roughly $1.2 billion. The cost of borrowing becomes tiny compared to the increase in asset value. From their perspective, selling would have interrupted that growth. Borrowing lets the investment keep working. This strategy became especially attractive during years of extremely low interest rates. For much of the 2010s and early 2020s, borrowing was historically cheap. Some wealthy investors could access loans at rates ordinary people could only dream about. Cheap debt, rapidly rising stock markets, minimal need to sell. For many billionaires, it was the perfect combination. But there's another layer that's even more surprising. Borrowed money generally isn't considered taxable income. Think about your own mortgage. The money the bank lends you isn't treated as income because you have to pay it back. The same principle applies here. If a billionaire borrows hundreds of millions against stock, they receive enormous spending power without triggering the taxes that a stock sale might create. Critics argue this allows the ultra-wealthy to enjoy their fortunes while delaying taxes for years or sometimes decades. Supporters respond that these loans aren't free money. They're debts. Eventually, they must be repaid. And that's true. But repayment doesn't always happen the way you'd expect. Sometimes the loans are refinanced. Sometimes they're paid back after small stock sales spread over time. Sometimes dividends help cover costs. And sometimes life ends before the assets are ever sold. This is where estate planning enters the picture. In some tax systems, inherited assets receive what's called a step-up in basis. Without diving too deep into legal details, this can reduce the taxable gains that heirs eventually face compared to selling during the original owner's lifetime. It's one reason why financial planners often describe borrowing against appreciating assets as part of a long-term wealth preservation strategy. Of course, there's a catch. Actually, several. This strategy only works when the collateral keeps its value. If the stock falls sharply, banks become nervous. Imagine borrowing against shares worth $10 billion. Then the market crashes. Suddenly, those shares are worth only $6 billion. The bank may demand additional collateral, or it may require part of the loan to be repaid immediately. That's called a margin call, and it's one of the biggest risks in this entire system. We've seen versions of this happen before. During financial crises, during sudden market crashes, and even recently, when several technology stocks experienced dramatic declines. Extreme leverage can turn from a powerful tool into a dangerous trap almost overnight. That's why many billionaires are surprisingly conservative with how much they borrow. The headlines may mention billion-dollar loans, but compared to the size of their total holdings, the actual borrowing is often relatively small, because the real goal isn't maximizing debt. It's preserving flexibility. This also explains something that confuses many people. When you hear that a billionaire's net worth increased by $15 billion this year, it doesn't mean they earned $15 billion in cash. Most of that gain exists only because the market now values their shares more highly. Their fortune can rise dramatically, while their bank account barely changes, which makes borrowing even more attractive. Cash without selling, liquidity without exiting the investment, spending without immediately realizing taxable gains. It's a financial strategy built around one simple idea: keep ownership, because ownership is where the real wealth compounds. Still, this system raises uncomfortable questions. If ordinary workers pay taxes whenever they earn income, while the wealthiest can often access enormous amounts of cash through loans backed by appreciating assets, is the tax system measuring income, or simply measuring who has to sell? Governments around the world continue debating changes to wealth, taxation, capital gains rules, and estate laws. Some argue the current system rewards entrepreneurship and long-term investing. Others believe it creates an uneven playing field where the richest people can legally access money under entirely different rules than everyone else. The debate isn't really about borrowing. It's about what wealth actually means. Is someone rich because they have cash, or because they own assets that banks trust enough to lend against? That distinction may seem technical, but it quietly shapes how fortunes are built, protected, and passed from one generation to the next. And perhaps the most surprising part is this: the biggest financial advantage of being a billionaire isn't necessarily having billions of dollars. It's having assets so valuable that you rarely need to sell them at all. So the next time you see a billionaire buying another company, another mansion, or another private jet, ask yourself one question. Did they actually spend their money? Or did they spend the bank's?